Hey there, Brian Bogner, along with Greg Towner. I want to wish you a very, very Merry Christmas here as we record this here in mid-December of 2025. 2025 is coming to an end, and we want to give you just some insights and interesting things that we're seeing in our five charts in 5 minutes as we close out this year. So, without further ado, Mr. Towner, let's go ahead and get started.
Yeah, absolutely. Well, Brian, that we usually like to start off looking at the S&P 500 here over the last 3 years. Obviously, it's been in a mostly an uptrend during that period. But we focus in on the far right there, the last, say, 2 or 3 months. Things have kind of stalled out, consolidating in a sideways manner. Now, again, this is the market cap weight index. So this is really factoring in all those big mega cap companies that we're all familiar with. So not a downtrend by any stretch, but stalled out in the uptrend for the moment. But if we look at those same 500 stocks, but instead of market cap weight, we equal weight all of them to give greater weight to all the other non-mega cap names. That actually, if we look at the far right, has broken out here recently to a new all-time high. So for the first time in a while, some other areas that we've talked about are working, whether that's small caps, whether that's international, value, that sort of thing, have started to work.
We know that, Greg, that, going back to this other chart here, when we look at mega caps, it's very tech heavy, right? And tech companies and things like that. So what are some areas in the market here that, maybe are rotating here that are outperforming and causing some of this a little bit?
Yeah, absolutely. We've started to increase our exposure to areas that are acting better, such as healthcare, financials. Certainly, like I said, the international and smaller mid cap areas are areas that we think are not only performing well, but show good valuation looking out into next year.
Excellent.
So, what are some reasons why maybe the market has stalled out here? I think this is the big one. This is the Fed right now is kind of in his tug of war of, there are two things that they focus on. The job market, which we got that data today. This is the 16th we're recording this. The unemployment rate ticked up again. So that would mean the Fed might be apt to cut more early next year. However, we don't have a chart for this yet because inflation data is delayed from the government shutdown. We'll get that in a few days from now. But they're worried about the stickiness of inflation. So that's kind of the tug of war the market and the Fed is in right now, the job market versus inflation. And so we're going to be really watching that as we head into the new year. Probably the other thing, and this isn't new, this is something we've been hearing about for quite a while. Stocks are expensive. The market is expensive. And we won't deny that from the higher level. I mean, certainly stocks are not cheap by and large. But markets rotate to areas that do offer valuation, like we just said. That's probably why we're seeing some of the valuation. Also keep in mind, really, when you're looking at, valuations, they're not a good timing tool, right? You look at any study 1 year out, valuations mean nothing. You got to look further out. And this is dangerous to justify high valuations, Brian, but I will say that profit margins in companies are at all-time highs. And so I think you can justify higher valuations in the market compared to 30, 40 years ago when companies were making expensive little manufacturing gadgets instead of technology. And then our next chart really, to me, hammers home why you can justify, some future gains in the market here. Earnings per share are growing. Earnings are growing. At the end of the day, companies need to grow their earnings to justify their valuations, and they are expected to do that next year. Also, I listen to a lot of company calls. They're talking about they're seeing good earnings growth, seeing good profit margins, and they're beating estimates. So certainly some concerns around the market, but we think earnings growth should be able to overstand all of that.
So just like you talked about, Greg, this market rotation is normal. It's actually healthy, right? When you only have a few stocks driving things higher, it has some concern. We're starting to see some great positive rotation and into some other areas. It's a good thing. However, like you said, the Fed is really in this, in between these two things, right? Well, the job market's not looking great, so we need to lower rates. Uh-oh, but we've got inflation, so if we lower rates, we might feed into inflation. So it's going to be interesting to see how they manage that. And really, I would say, based on what you said here, Greg, the thing that these are the two things that really, if we're looking at what the market's going to do, is really paying attention to as long as companies continue growing their earnings and maintaining their high profit margins, then that justifies where the market is. Any cracks in these two, I mean, we could certainly see some corrections, they just happen, but any cracks in these two things, and then would probably be something to really keep an eye on. All right. Well, on that note, Greg, do you have anything else?
No, I think we're good. Have a Merry Christmas.
Yeah. Have a Merry Christmas. Happy New Year. Thanks so much for watching. And of course, if you have any questions, this is where you can reach us. Shoot us an email. Give us a call. We'd be happy to talk through all of these things with you. But thanks again for watching. We'll see you next year.